In the earlier topic, we described the basics of options. I urge you to review it before watching this one. Options are powerful tools that allow investors to profit from their view of the future in an efficient manner. For instance, if an investor believes the stock to appreciate in the future, he would choose to buy calls and/or sell puts on the stock. Conversely, if the view is for the price of the stock to fall, you can consider whether to buy puts and/or to sell calls. The above are only naive examples of possible future outcomes. Sophisticated investors are likely to have more precise expectations of the future. An investor, for example, may hold the belief that a stock is going to appreciate, but not more than 10% over the next 2 months. A clever combination of two call options is called for to achieve the maximum percentage gain. As we will see in this presentation, options, along with the underlying asset and appropriate borrowing and lending, can be combined in innovative ways to generate maximum profit given specific views that the investor has about future outcomes. We will start with a motivating example. Consider a firm that is facing a major lawsuit. If the case is ruled in favor of the firm, the stock price will experience a large increase. On the other hand, if the judgment goes against it, the stock price will see a significant decline. What could an investor do under such a scenario? As you may have guessed, an appropriate strategy would be to buy both a call and a put on the underlying stock. If the stock appreciates, the call will be in the money and the put can be discarded. If the stock declines, the put will be in the money and the call can be discarded. So regardless of which way the court judgment goes, the investor will stand to gain provided the price movement exceeds the combined cost of buying the two options. This strategy of buying a call and a put in the options jargon is called buying a straddle. A straddle pays off when a stock is likely to experience very large volatility over the near horizon. The following graphic illustrates the payoff on a straddle. One can also imagine the opposite situation where the investor believes that a particular stock is going to experience very low volatility over the next 2 months, i.e., the stock to trade within a very narrow band. An attractive profit strategy in this case would be to sell the straddle, in other words, sell a call and sell a put. We will look at some extended strategies in the following sections. A protective put. In this example, we will look at how an investor can purchase protection against possible declines in prices of underlying stocks in the investor's portfolio. If you're holding a stock currently trading at, say, rupees 100, purchasing a put at an exercise price of rupees 100 will ensure that the portfolio value will be guaranteed to be worth 100 rupees even if the stock price were to decline to 0. If the stock appreciated to, say, rupees 110, you would have the stock which is valued at rupees 110 and the put can be allowed to expire. If the stock declines, on the other hand, to rupees 90, you would exercise your put for a payoff of rupees 10, which along with the stock valued at rupees 90 would have a value of rupees 100. A protective put is thus a portfolio consisting of the underlying stock and a long position in a put, allowing the investor to participate in stock appreciation and at the same time protect against declines in the stock value. The cost of the strategy, of course, is the outlay required to purchase the put. Let us extend this example a little further. As you may have realized, the price protection requires you to invest in the purchase of the put option. Part or all of the investment can be mitigated by the sale of another option. For example, if the investor believes that the stock is unlikely to move above rupees 120 or is willing to give up the gain beyond rupees 120, the investor could choose to finance the purchase of the put by selling a call at an exercise price of rupees 120. Let us put some numbers to illustrate this. XYZ stock is currently trading at rupees 100 A 3-month put at an exercise price of rupees 100 is trading at 10 rupees, and a 3-month call at an exercise price of 120 is trading at rupees 10. The investor buys the stock and simultaneously buys the put and sells the call. The net investment is therefore rupees 100. The following table shows what the payoffs are for various stock price outcomes at the end of 3 months. Interestingly enough, an identically similar outcome can be achieved by a seemingly different portfolio, which consists of depositing the present value of rupees 100 in a bank account and simultaneously buying a call with an exercise price of 100. This equivalence is the consequence of a well-known result in finance called the put-call parity theorem and is explored in greater detail in the deep dive section of this presentation. You can see from the table that the portfolio is protected at rupees 100 regardless of how much the stock may decline, but provides upside potential of up to rupees 120. Other examples of option strategies include vertical spreads, which are extensions of the above example, where the investor finances the purchase of an option by the sale of another option at a different exercise price. Popular spread strategies include bull call spreads, bear call spreads, bear put spreads, and bear put spreads. Other strategies are available in the deep dives related in this talk. Please come back for more and feel free to post questions on the PI website.